There is light at the end of the tunnel. That's according to Bank of England Governor Andrew Bailey, delivering a speech today to the Resolution Foundation. Some fascinating insights and predictions in this speech about what the UK economy could look like post-COVID as we embrace the new normal. In this video, why I believe Andrew Bailey is mostly right on this occasion, along with his comments on the new normal of flexible working and the prospect of negative interest rates. There's quite a bit to unpack. Hi everyone, I'm Martin Bamford, a chartered financial planner, personal finance YouTuber and money author. On this channel, I talk about personal finance, investing and happiness. I make these videos to help you become wealthier and happier. If that sounds like a great result, click on that little red subscribe button to become part of our subscriber community. It's completely free and you'll never miss an episode. This was a speech delivered today. It was titled Getting Over COVID. Bank of England Governor Andrew Bailey was talking to the Resolution Foundation about the post-COVID future for the UK economy as it recovers from the pandemic. The timing of today's speech is particularly important because today, the 8th of March, is the first step on the roadmap to recovery, with children returning to school in England and a slight easing of other lockdown measures. In the speech, Bailey looks at the nature of the shock to the economy and how it may change the way that people work and shop. He emphasises the importance of boosting investment and productivity growth, two areas where the UK economy has historically struggled, and even more important post-COVID as we attempt to raise the sustainable rate of growth for the economy. Bailey also shared some thoughts on what all of this means for monetary policy action taken by the Bank of England. Those thoughts come shortly ahead of the latest Bank of England Monetary Policy Committee meeting later this week, with continued talk around about negative interest rates, but also fears about inflation running wild, and that could mean we need to raise interest rates, so arguments in both directions. So 4 important points in this speech, which I'll look at in turn. Point 1 is that COVID has been both a demand and supply shock to the economy, which means the economic recovery has to address both demand and supply. Bailey talks about the need for a dual recovery, otherwise it will be difficult to deal with the issues that arise. He states the obvious here by saying that the economic impact from COVID-19 has been very large in aggregate. He says that by the end of this quarter, the first quarter of 2021, the size of the UK economy will still be about 12% smaller than it was at the end of 2019, and this economic shock has been synchronized across global economies. The economic shock seen globally has far more similarities than it does differences. Parts of the economy which require a large amount of close human contact have been hardest hit by COVID, and that's resulted in the uneven and unequal effects of the pandemic, because those sectors hardest hit tend to have the highest numbers of female workers, low-paid workers, and those from ethnic minorities. But the impacts of the COVID-19 pandemic on the economy have been both on the demand and supply side. The act of closing down the economy through various lockdowns affects both demand and supply. So Bailey points out that while there's a gap opening up between demand and supply during the pandemic, both have been hit. He compared that to the impact on demand following the global financial crisis and the persistent period of spare capacity created. Following this dual impact on supply and demand, it shaped the policy response to COVID-19. Bailey highlights that in particular, the so-called furlough scheme was shaped by that impact on supply and demand. Furlough has helped to avoid a much larger spike in unemployment because it temporarily supported those jobs that would have otherwise been lost. So had the furlough scheme not been in place, it's easy to see that it would have been a smaller fall in supply and a much wider margin of spare capacity in the economy. But from a monetary policy perspective, Bailey explains that we need to focus on the recovery of both supply and demand. Compared to previous recessions, it's slightly unusual that this requires more of a focus on the supply side. But some of the restrictions in society, which have hit the supply side, with only temporary restrictions on activity and voluntary social distancing, for example, those restrictions lifted should help to restore the supply side, and also the progress with the vaccination programs will enable those restrictions to be used and eased more rapidly. However, the changes to the supply in the economy which are longer lasting, the scarring effects and the structural changes, these are going to be around for a whole lot longer. Secondly, he doesn't think the long-lasting economic damage from the pandemic, the so-called scarring effect, will be as extensive as it was in past recessions, but there will most likely be structural change which will influence the future of supply and demand. This required structural change is what we often hear being called the new normal. What does the new normal look like? I think that's a big question still for a lot of people at the moment. Back in November's monetary policy report, the Bank of England already took a look at this and broke it down into three main areas: what we buy, what we make, and how we work. Now, clearly, our lives under COVID-19 have undergone significant adjustment, but we don't yet know whether these adjustments will be permanent or temporary, especially in terms of their impacts on the economy. Bailey talks about remote working. And back in the autumn, around a third of people in the UK were working remotely, at least some of the time. Service businesses in particular are much more likely to have people working from home. To go to a third of people working from home, at least some of the time, is a huge increase from its pre-pandemic levels, when it was only around 5% of people in employment mainly working from home. In terms of what we buy, this has changed significantly too. Online shopping now accounts for around 35% of total retail sales. That's up from 20% last February, just before the pandemic. Again, we don't know whether or not that habit, that shift to online shopping, is there to stay for good. I suspect we might see at least a temporary return to the high street. Once people are allowed to go shopping, I think they'll go a bit mad. A real boost for bricks and mortar retailer, but I'm not convinced that'll be a long-term change. So this is all the conundrum for policymakers right now, wondering whether we're seeing structural change in the economy and trying to understand what the potential impact of that structural change might be. The pandemic is messing with the usual way of the economy, its usual economic cycle. Bailey explains that usually falls in output are accompanied, initially at least, by relatively small falls in the number of hours worked, and then significant rises in unemployment tend to come later. There's a lot in his speech about the potential for structural change in the employment market, but he feels that because of such a big emphasis on the UK as a service economy, variation in the skills demanded by employers across industries has probably shrunk over time. And then he goes back to the furlough scheme as this policy intervention which helped preserve viable employment in the future. But there's potentially a bigger issue here around capital, including plant and machinery, which is much harder to relocate, even if the pattern of work is quite similar. So this rise in home working, flexible working, if it's sustained, it could prove very difficult to relocate the production of various things. It looks like the new normal for remote work will be some sort of hybrid approach. Bailey explains that half of new remote workers say they would like to continue to work from home all or most of the time, even once pandemic restrictions have been lifted. And in some sectors, the proportion of staff that work from home on a regular basis will more than double. But the Bank of England's agents, the people that get out there on the ground and try and work out what's going on in the economy, they expect to see a hybrid model of people working 2 or 3 days a week in an office or in the workplace, and then working from home for the rest of the time. That is likely to become the new normal. In terms of what all of this means for productivity, clearly the impacts of COVID has had a negative impact on productivity. Bailey estimates the average unit costs have gone up by about 7% in the second and third quarters of last year because of COVID restrictions. While unit costs will start coming down as restrictions are lifted, there will be more persistent negative impacts of around 2%, and that reflects some of the new costs incurred by businesses, including personal protective equipment and screens, for example, but also because business capacity is likely to be forcibly reduced because of measures like social distancing. In the speech, Bailey refers to something called the batting average effect. This is the impact of COVID moving the composition of activity towards higher productivity firms, so competition and innovation playing a role here. He still believes that the impact on productivity resulting from working more often at home is not yet clear. There's a positive from reduced commuting time, but there may be lower innovation and creativity when people are working remotely. So on that second point of the longer term negative economic impacts of COVID, and Bailey believes that they'll likely be smaller than they would have been following past recessions. That's because task and job reallocation, and also to some extent capital redeployment, has increased since earlier recessions. Workers, for example, will need less significant retraining in order to move between sectors because the service sector is broadly similar in terms of the skills required. He believes the supply capacity of the economy is going to be around 1.75% smaller than it would have been had we not had the COVID pandemic. That's by the end of their forecast period. Third, Bailey says it's important to boost supply capacity to raise the sustainable rate of growth in the economy and thereby ease the task of managing the necessary higher level of public and corporate sector debt. He talks about elevated uncertainty, which is expected to continue to reduce investment levels levels. He makes reference in the speech to the period following the global financial crisis and explains that while business investment did recover from a very low base, it was still too weak in that period immediately prior to the onset of the pandemic. While there was growth in government investment, that was also generally weak during the same period of time. The shock from COVID required a big increase in public and business debt, which Bailey describes as a necessary and sensible response, and says the debt means that the economic impacts of COVID will be spread over longer periods of time. But we don't yet know for how long the impacts will be spread, and it's apparently too early to predict. Managing the cost of that debt will be easier if we have a higher trend rate of economic growth, which will be boosted by stronger investment. Another reason why we need stronger business investment is the transition demanded by climate change and enabling a more digital economy. So Bailey's message here is that stronger growth in potential supply, supported by stronger investment and productivity growth, will make it easier to recover from the shock of COVID. He feels the Bank of England's actions during the pandemic could also have helped reduce the extent of that long-term scarring of the economy. Those Bank of England measures include making sure there was an appropriate supply of finance for productive investment, but also about fiscal policy, in other words, government spending, with the government supporting the economic growth through an investment in infrastructure, skills and innovation. What does all of this mean for the Bank of England's monetary policy response? Well, this is point 4 in his speech. He says that there's a growing sense of economic optimism, both in financial markets, but also in consumer and business confidence measures. We've got a declining rate of new COVID infections and fantastic progress with the vaccination programme. This is why he refers to it being light at the end of the tunnel. But Bailey also injects a note of caution and a dose of realism here, because the economic recovery is starting from a lower level of activity as a result of current restrictions and people's natural caution. So it is going to take time to get back to its position where it was pre-COVID. We're likely to see a faster economic recovery, but that's because the starting point is lower than it was even in the autumn. Bailey restates the Bank of England's expectation that price inflation will return to around its 2% target, and recovery will also be supported by low interest rates and quantitative easing. In the speech, Bailey explains that the bank will continue to execute the announced programme of asset purchases, and they expect to complete those by around the end of this year. And they're also going to maintain their forward guidance, which states that if the outlook for inflation weakens, the committee stands ready to take whatever additional action is necessary to achieve its remit. The committee does not intend to tighten monetary policy, at least until there is clear evidence that significant progress is being made in eliminating spare capacity and achieving the 2% inflation target sustainably. That forward guidance from the Bank of England should give the economy and businesses within the economy a reasonable level of confidence as things start to get back to normal. And it's worth noting this isn't just about inflation exceeding the 2% bank target before monetary policy is tightened up and interest rates start going up. We also have to see this elimination of spare capacity in the economy. He finishes his speech with some thoughts on negative interest rates, which are part of the toolbox of measures that the Bank of England can deploy, explaining that while they ask banks to make preparations within the next 6 months, that request was made last month, in case they need to use this approach of negative interest rates to provide further support to the economy, that should not imply their intentions about negative interest rates. So negative interest rates and the decision to use them by the bank are what Bailey calls state contingent at all times. If the Bank of England needs to significantly tighten its monetary policy, yes, we might well see negative interest rates, but from Andrew Bailey's speech today and this earlier forward guidance and my read of what's going on out there at the moment, I don't think we're there yet. And I would be incredibly surprised to see that move at the Monetary Policy Committee meeting later this week. What did you make of Andrew Bailey's speech? It's not often I find myself nodding along in agreement with Andrew Bailey, but there is a lot of good sense in there on structural changes to the economy post-pandemic, on the new normal of shopping online and working from home, and on the monetary policy response to inflation. Do leave a comment below. Let me know what you made of it. Thank you for watching this video. Until next time, I'm Martin Bamford, and remember, when it comes to your money, the more you know, the faster it can grow.